You know that feeling, right? You walk into a store during the holidays and it's just packed to the rafters with stuff. Have you ever stopped and wondered, how on earth did all of us get here? It's honestly mind-boggling. Well, behind all that holiday cheer is a really fascinating financial balancing act. And today, we're going to pull back the curtain on that hidden engine that powers it all. So let's just get right to it. How does a massive retailer, a store just overflowing with toys and electronics and all of those decorations, how do they pay for all of it months before you and I even think about buying it? It's a huge financial puzzle, and the answer is actually pretty clever. And this puzzle, well, we can basically call it the holiday stock-up problem. It really is the core challenge that pretty much every seasonal business has to figure out. Okay, let's just paint a picture here. Imagine it's the middle of August. You're probably thinking about the beach, right? But a company like Target, they're already placing enormous orders for the holidays. We're talking millions and millions of dollars worth of products. And here is the real problem. There's this huge gap in time. All this cash is flowing out of the company in, say, August to pay its suppliers. But the money from you, the customer, isn't going to flow back in until November or December. That creates a temporary but really significant cash flow issue. So, how do they bridge that gap? How do they do it without completely draining their bank accounts? Well, they rely on a kind of financial lifeline. And that lifeline has a name: short-term financing. It's money that's specifically designed for immediate needs, to cover exactly these kinds of temporary cash shortages we're talking about. So think of it less like a mortgage for a new building, and more like the cash you need to manage the everyday ups and downs of business. Now, when we say short-term, the world of finance is actually pretty specific. It usually means that any loan or credit is meant to be paid back within 1 year. It's a quick fix for a temporary problem. So, what does this financial lifeline actually look like? Well, a financial manager doesn't just have one option. They've got a whole toolkit they can choose from. And here are the 4 big ones. First up, you've got trade credit. This is basically getting your suppliers to give you a little more time to pay them. Think, pay me in 60 days instead of 30. Simple. Then you have bank loans, which are, exactly what they sound like. Commercial paper is a bit different. It's essentially a big IOU that a large trusted company can issue to raise cash fast. And finally, there's factoring. That's when you sell your invoices, the money customers owe you, to another company at a discount just to get that cash in your hand right away. So let's bring this back to our Target example. To solve that holiday stock-up problem, they might use trade credit. They could tell the toy manufacturer, hey, we'll pay you in 60 days. Or they could just get a straightforward short-term loan from a bank to cover all those inventory costs, knowing that they can easily pay it back once the holiday shoppers start swiping their cards. But here's the thing. You can't just pick one of these tools out of a hat. It takes a really careful strategy. It's all about making the smart choice for your situation. So a financial manager is going to look at their options and weigh the pros and cons. They'll ask, what's the cost? The interest rate on trade credit might be 0 if you pay on time, which is amazing, but the repayment term is super short. A bank loan, on the other hand, gives you more flexibility on when you have to pay it back, but the interest you pay really depends on how good your company's credit is. See, it's always a trade-off. At the end of the day, all of these decisions, all these trade-offs, they're all driven by one single core principle, and that is liquidity is absolutely key. This quote right here just nails it. Liquidity is really just a fancy way of saying you have enough cash on hand to pay your bills. The goal is to make sure you always have that cash, but without over-leveraging, which means you're not loading up the company with a mountain of long-term debt that'll weigh you down later. So, to put it really simply, short-term financing is the art of being financially agile. It's about making sure you can pay your employees, pay your suppliers, and keep the lights on today, using temporary funds that you can pay back tomorrow, all while making sure your company stays healthy in the long run. And that kind of leaves us with one last thought. This whole thing isn't just for giant companies like Target. Think about the businesses in your own life. Your local coffee shop, the corner bookstore, maybe even a seasonal farm stand. They are all doing this exact same financial dance every single day to manage their cash flow. So the next time you walk into any business, just think about that invisible flow of money that's making it all possible.